The performance data from 2025 makes a compelling argument against U.S. home bias. Emerging markets returned 30%. Developed international markets gained 27%. Japan's Nikkei rose 14% for its third consecutive double-digit year. Europe gained 10%. The US S&P 500 delivered a strong 16%, but it came in third among major equity regions. 5 reasons international outperformed. First, the weakening US dollar automatically boosted returns for US investors holding foreign assets. A 5% to 8% currency tailwind on top of local returns. Second, the European Central Bank cut rates more aggressively than the Fed, boosting equity valuations across the Eurozone. Third, Japan's ongoing corporate governance reforms continued to unlock shareholder value. Buybacks, dividend increases, and strategic restructuring all drove the Nikkei higher. Fourth, South Korea's Kospi surged as Samsung and SK Hynix became critical links in the global AI chip supply chain, with the Kospi posting its best year in over 2 decades. And fifth, valuation. Emerging markets traded at approximately 12 times forward earnings versus the S&P 500's 22 times, a significant discount that drove mean reversion. The average U.S. investor holds over 70% of their equity allocation in U.S. stocks. Yet the U.S. represents only 60% of global market cap. That home bias, the tendency to overweight familiar domestic assets, is a documented behavioral bias that costs real returns over time. The solution is systematic global diversification. A target portfolio might look like this: 45% in VOO for U.S. large-cap exposure, 20% in VEA for developed international markets, 10% in VWO or EEM for emerging markets, 15% in BND for bond market exposure, and 10% in IAU for gold as an inflation hedge. Within international allocation, 4 specific regions stand out heading into 2026. Europe for its ECB rate cuts and defense spending, boom, the VGK ETF. Japan for continued corporate governance reform momentum, EWJ with currency hedging via DXJ. South Korea for Samsung and SK Hynix as direct AI chip beneficiaries, EWY. And India for its demographics-driven long-run growth trajectory as the world's fastest-growing large economy, INDA, or the new Wisdom Tree India ETF. The mechanism is straightforward. When the Federal Reserve cuts rates and the U.S. dollar weakens, international returns are automatically amplified for U.S.-based investors, making global diversification particularly valuable in exactly the macro environment the Federal Reserve is engineering for 2026. This is the disclaimer slide. All content in this presentation is for educational purposes only. It does not constitute investment advice. Viewers should consult a licensed financial advisor before making any investment decisions.